Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 26, 2016. In this video, I'll take a look at the dollar, the US dollar index, and as well as some of the dollar-sensitive assets, such as gold, the gold mining stocks, which of course follow gold. We'll look at oil, touch on a few commodities, maybe some of the industrial metals if we have time, copper. Also wanted to look at platinum and give you my views on where they're going. You know, for a while there, I was doing a lot of active commentary and posts on the dollar, on special on gold, GDX, precious metal. But as I've stated in the last few weeks, there just haven't been many significant developments or anything worth noting, really worth acting on. For the most part, gold's gone nowhere for months now. It's been in a trading range after that huge run up earlier in the year. And either way, for what it's worth, I do see some interesting developments both in the dollar and in precious metals and some other commodities. So we'll dive into the charts here. Starting out with the dollar, this is the U.S. dollar index. I'm looking at a daily chart that spans 2 years. And this is a trading range, this white shaded area up here that runs from, up here a little bit above the 100 area down to about the 93 area. That's the trading range we've been in since early 2015. I've highlighted this for a while, stating in the past that, the next major trend in the US dollar is likely to be determined by which way this range breaks. This is a long-standing, very, very powerful. The longer you have a relatively tight sideways trading range, and this one's gone on, as I mentioned, for, going on almost a year and a half now, the more powerful the breakout. So, and lasting as well. So we'll keep an eye out on this. We are close to the bottom of the range now, and I mentioned before, and I'll touch on the weekly charts in a second here, that I do favor ultimately a downside break of this range, but right now I'm favoring some near-term upside. So what that would mean, if I'm correct, the dollar may be poised to rally here soon. Reverse trend, as you can see here, the dollar's been in a downtrend since hitting the top of this range, really all the way back here. And it trades fairly well. You can see all the patterns within. We had this rising wedge pattern, breakdown, impulsive move down. Now, most recently, what I'm focusing on is this rising wedge. If you look at this downtrend line here, capturing all these reaction lows, and this steeper downtrend line up above, you can see that the U.S. dollar has recently broken out of that trading range. We'll zoom in there and you can see it. So here's the bullish falling wedge pattern. There's a breakout. Towards the bottom of the range, there is a little support lower. There is a possibility maybe the dollar wants to come in and back test that wedge, this trend line at a lower level. This is horizontal support here around 93.90, call it. And then this is really the bottom of the range, the major support down around 93. And so that's one possibility, although I'm looking at this, we do have divergence here. And this is a common theme. I'm seeing divergences out on the daily time frame. I've pointed out quite a few divergent highs in GDX during that monster rally, well into it. Looking for pullbacks, and each and every one played out, but much less, for a much more shallow move than one would have anticipated. That was a very strong rally. So those 60-minute divergences didn't really play out as much as they might normally had the trend not been so strong. Now we have daily divergences, which are even more powerful and more likely to play out. It's not very often you have bullish divergences on the daily chart, as well as negative divergences on some of the metals and other commodities. That's what I'll get to here in a minute. So there it is. There's a bullish falling wedge at or very near support. You can see sometimes we've had, and that's why I have two lines here. I have the green line as really a key support level, but I do have this white line. You can see as if you follow the cursor, several reactions on around that level there. So that's something worth watching, including quite a few reactions there. In other words, this line has acted as support, and the dollar has since been moving higher. Just zooming in kind of on a shorter term basis, if I put a horizontal line here, you'll notice that's what's capped these recent candlestick highs. And it actually, if you go back to the left of the chart, you'll see quite a few reactions off that level. So really move that up just a hair. And the dollar index is an end-of-day chart, at least on this charting service it is. You can watch UUP or dollar futures on any of the other quotes that you have, the trading platforms. This is at 93.25, 95.23. I'm sorry, on the DXY. So that's a level to watch, and then that might take us up. You can see the overhead targets right here. Again, I remain longer term bearish on the dollar, so how far and how much this plays out, hard to say. Really, all I'm looking for right now, as I mentioned in the video the other night on the basic material sectors, which are also related to the dollar. They are dollar sensitive because basic materials, a lot of those, commodities, industrial metals, and things like that, they also are dollar sensitive. So again, my take here is maybe some near term, intermediate term upside in the dollar, downside in commodities, including gold and GDX, and that would be an ideal target. You have this horizontal level here, which is pretty well defined. You can look to the left and just note all the reactions. I've had that line there for a while, and this potential downtrend line coming in off the tops, this yellow downtrend line. So that's the outlook for the dollar, and then we'll see. The charts are dynamic, and so is my analysis. So if this changes throughout time and we continue to move higher, maybe we have an upside break, and I'll have to respect that. Until then, anything within the range, all you can really do is trade the extremes. That's the best way to trade a range. You can use these patterns as I'm using here to try to figure out where within the range it's going. And then when you get to the top of the range, that's either an objective short entry on the dollar, for example, or you wait for a breakout if that's what you're expecting, and then you wait for a confirmed break above the top, and then you go long the dollar. Vice versa on the downside. If you can go long towards the bottom of this range with a stop below, or you can wait for a break down and then short the dollar, or go long dollar sensitive commodities, things of that nature. Now, again, it's these quite a few things down here. I didn't put all the arrows. You can see in the past I've pointed this out. If you note where these arrows are, just look above at price, follow the vertical line up, and you can see that once you get these oversold readings, there was a cluster here, so you really want to go off the last of the three tags there, and you can see the dollar rallied. Here we were oversold, and the dollar rallied. Here we were oversold, dollar rallied. Oversold, oversold again. Again, I could put a few more arrows here. This is really a triple tap, 3 consecutive oversold readings in close proximity, and that increases the odds that the dollar is due for a decent bounce. And again, folks, dollar up means dollar sensitive commodities down. And on top of that, as I mentioned here, we have positive divergence. We have pretty much three equal lows on the RSI, yet prices were making a series of lower lows, so that is positive divergence. And we do have a slightly higher low here on the MACD. So that's enough on the dollar, except just want to hit on the long-term charts. We have very strong negative divergence, which I've pointed out here. This is that same trading range I had highlighted in white. And, as you can see, the dollar it had this tremendous rip, and it's for over almost a year and a half now gone nowhere but sideways. And, I should say a fairly large range, for a currency, but pretty well defined. And again, the next break, solid, break. I'm talking not just this was an intra-week break. We're talking a weekly close, especially 2 weekly closes below or above the top or bottom of this range is likely to determine where the dollar is going. And it's a lot of what I'm seeing down here and some other things that really let me favor ultimately a downside break, but as I said, maybe some near-term upside. Maybe this thing's not ready to break down yet. And if it is, then we respect that. If this turns around and we have a breakdown, then I'll have to position accordingly. All right, let's look at we'll dive into gold. I know I probably have more inquiries on gold and GDX than pretty much anything else out there, including the U.S. stock market. This is gold, a little bit busy here. Apologize for that. A lot of trend lines, Fibonacci levels, things of that nature. Probably should move this one up here. All right, so what am I seeing on gold? Here's what I see. First, I will note, as I mentioned a minute ago, I'm seeing a lot of divergences on the daily time frame. You can see the RSI, a steep downtrend line here with a peak and a lower reaction high. There's a MACD also negative divergence, and what I'm referring to here is price. From this peak right here, you have to take a horizontal line. I'm sorry, vertical line. You can draw it up. So from those points to right here, price has made a higher high in gold, and the RSI and the MACD both made lower highs. That's negative divergence. So that's bearish. Bearish technical event number one. That divergence is confirmed, was confirmed a while ago. The MACD is still holding above that zero line, which is bullish for now, but it's flattening out, really hasn't done much. RSI is holding at that 50 level, which is sort of neutral territory. Typically, you're in a bullish trend when above 50 on the RSI, bearish when below. Just rough rule of thumb, really. Now, some other things I've noted, you had this tremendous rip off the lows following this divergent low back in, it's actually December was the bottom in gold. The miners bottomed in January. And this had very much had the appearance of a bull flag pattern. And, I mentioned my skepticism on that and my reluctance or outright, refusal to buy into that. Gold was too stretched at the time, so I've really stayed, for the most part, stayed clear of it for a while now. And what I'm noticing is this bull flag so far, if it was a bull flag, has not played out as it should. Bull flags are really comprised of three components. You have a very impulsive move up. Impulsive means strong, not straight up, but a very unidirectional move up to a point where you have consolidation, typically on below average volume. Didn't really see a big volume taper off here during that flag, so that would really take away a little bit from the validity of that being a bull flag. But with that being said, a little bit of volume drop off, just not a lot. Now, more importantly, you want to see prices explode out of a flag pattern. Typically, the breakout and the ensuing move up should be roughly equal to that leading up to the flagpole. And so far, that has not been the case. So, I'd imagine that a lot of traders out there view that as a bull flag continuation pattern, and as such probably positioned in anticipation of or following a breakout. And so far, that breakout has been very lackluster. And in fact, gold has gone nowhere, as I've mentioned. If you look at where we're at today, 118.23, and I am doing this video before the market opens. You go back here, this is middle of February. So gold has gone virtually nowhere. It went a little higher, went a little lower. So gold has been dead money, and again, this, folks, is why I've just, the analysis I put up has mainly been by request. Although now I am seeing a little bit more. I mentioned the negative divergence here. Did that play out? It played out somewhat. Usually on daily divergences play out a little bit more than just a month or two move down. You're looking typically at a trend reversal, or at least an intermediate term trend reversal. The longer term charts on gold, let me be very clear, the action over the last few months has been very constructive and is highly indicative of a new bull market in gold. So if that's the case, I'm not getting crazy or very enthusiastic about shorting it anymore from here, because sometimes what you have, especially in the early stages of a bull market, are negative divergences, bearish chart formations, things like that just don't play out, or at least don't play out to their measured or expected move. So gold might just be working off these near-term overbought conditions by sideways consolidation. But either way, be on the lookout. Anything can happen. And obviously, as most of you know, the gold went from extreme bearishness to extreme bullishness in a blink of an eye. I'm talking about sentiment here, in a relative blink of an eye. Yes, that move took a few months, but people were just foamingly bullish on gold here. The same people that didn't want to buy it here, and so you have to watch out for that. That's typical psychology in the market. Anytime you have a strong move in an asset, it ramps up bullishness, and likewise when you have a strong drop or a multi-year bear market, bearishness will be near its highs at the lows. So that's that. What else to tell you? The lines that you see here, this would be a target right here, 114.45-ish. If there's a little more downside, there's a gap below. I really didn't set this up for price targets. I just wanted to let you know that I'm seeing really not a reason to be long gold here. In fact, let me flip over to the miners for a second. Well, before I do that, I mentioned recently a couple times in the trading room or on the front page my thoughts on gold, the miners. The miners did break out, and I'll get to that in just one second. But I had mentioned that that breakout has an increased rate of failure, or at least I have no chance, or I'm sorry, no desire to chase that recent breakout in the miners because gold didn't follow suit. And what I was referring to, and I stated that this reaction high back here on that's March 4th when gold peaked. Gold is still well below that reaction high. And what happened, we'll flip over to the GDX chart. This is the breakout I was talking about here. This was a key level, about 2120, we'll call it. I have 2119 on that line there, but about 2120. Because GDX had consolidated. If we draw a little range here, you can see for a couple months we had a lot of consolidation. And then we broke out, and we broke out impulsively. Look at that big gap up. Came back tested the top, and moved higher. By on face value, that is bullish. You can see here, obviously, I'm sure some of you've picked up, I've just added this bearish rising wedge to GDX. But I mentioned that I had no desire to take this breakout because gold was not confirming. And one thing I can do is I can give you my word, if the gold doesn't follow suit, the miners are not going anywhere without it. They do have temporary disconnects, and sometimes the miners will lead, sometimes the miners lag, gold goes ahead, and then the miners play catch up. I pointed that out. I actually was pointing that out back here when I was bullish on gold, that gold was holding up. The miners made new lows, and gold was holding up and had not made new lows. And in fact, gold had bottomed back in December. And sure enough, the miners played a violent game of catch up to the metal. And right now, this is a case, in my opinion, of the miners getting ahead of themselves. They went ahead, broke out of that recent range, while gold failed to do so. Gold is still towards the middle, to possibly, towards the middle. We'll call it the middle, not the lower end of that range. And again, there's some signs there that it might have some more downside in the coming months. Then back to GDX here. Very clear, well-defined divergences. In fact, if you look at the MACD, it's pointed lower, poised to make a bearish crossover, which would give me what I call, that's just my terminology, that's confirmed divergence. This I only call potential divergence. Potential because this MACD line could turn back up and the MACD could go on to make a new high. But once we have a bearish crossover, meaning the blue line goes down under the white line, the MACD line below the signal line, that is, in my book, confirmed divergence. You can see the divergence here on the RSI, and again, focus on this line and this line, these two uptrend lines. That is a pretty clean, very steep bearish rising wedge, and if it broke down, yes, the top of that support range should act as support, but I wouldn't give it too much credit this time around because we already had a back test of that. And usually on support levels, I look for at least an initial reaction off a test of that level. And because this wedge is pretty steep, I would not be surprised. In fact, I would expect a breakdown and probably a move down towards the bottom of that range, call it, rough numbers, call it 1880. And that's probably all I'd be looking for. I wouldn't be surprised for a move down to there. But again, the longer term charts, we zoom out. I'm already on GDX. Let's look at the weekly chart. Okay, well, I'll stick with GDX while we're here, then I'll look at gold. This was the downtrend line I'd been watching for a very long time. I had two alternatives, a purple and the white downtrend line. A big, powerful, giant, bullish falling wedge. Clean divergences on the weekly chart, multi-year divergences, and on a scale of 1 to 10, that just couldn't have been any nicer. That, as far as a breakout, a very well-defined downtrend line, and a very impulsive move up. However, I've had forever and a day this alternative pattern here, this ascending or descending broadening wedge pattern defined by the same downtrend line, the lower downtrend line for the falling wedge pattern, as well as this downtrend line here. You can see it catches numerous reactions, and that's right where we stopped. So we're at the top of that descending broadening wedge pattern. And again, I favor an upside resolution ultimately of that, a breakout of that above that level, largely because of the divergences, largely because everything I've already covered in the past. I made the fundamental case for the miners with oil being down well below where it was when the miners bottomed back here, gold being higher than it was when the miners bottomed back here. So I made the fundamental case. I started making that last year. In the technical case, just as well. I've been making that for a while. However, too much, too fast. This is all I'm saying. So I'm looking for a pullback, and just on the weekly chart, this 2050-ish level that might be okay. Um, it's really hard to say right now how far and how deep it goes. But again, because the longer term charts appear bullish, I would err to the side of keeping my pullback targets on the short side versus the long side. I guess that's the easiest way to say it. Gold. And there's gold. Just look, forget about all these Fibonacci levels. Those just help define, I talked about this major support zone for, a couple of years, and that's where we hit the top of that zone. That's where gold bottomed. And I had this wedge type, just contracting channel, falling wedge, if you want to call it. It's slightly contracting, but again, with these strong bullish divergences in place. Again, this is old hat. This is stuff that was covered going into the end of 2015, and even back in mid 2015. And there's gold. You can see it from zooming in here. We broke out, back tested. We're above there. And again, that could be flagging action. So you just have to respect it. If it breaks out above that level, and we'll look at it here. We have gold appears to be flagging above the level it broke out, above this downtrend line. But again, I'm leaning towards one more pullback before a breakout. But you can respect a breakout of this line. But more importantly is that recent reaction high I mentioned in gold. And you can see it here, and that's right about 123.16. Again, take a look on the daily chart to get a more accurate number there. So that's gold. Enough on the precious metals and miners. We'll look at a few other things. Well, we'll stick with some precious metal. Here's a precious / industrial metal, silver and platinum. In fact, gold. They all have industrial and precious metal uses. There's platinum. This, in fact, I just had shares in a long-term account I just sold. Was late last week, I believe. And the reason being is this line here. This was a long-term target. There's a couple things here. The blue downtrend line, this was your primary downtrend line. We're looking at the daily chart here. So we had, there were quite a few divergent lows in the past, and each and every one played out for a very nice move. They weren't the move, the bottom, but you can just measure here, and you see that was about a, 12, 13% gain in platinum. But this one seemed to have done it. This seemed to be the final, or what I believe to be the final divergent low in the bear market in platinum. And I'm talking back on, looks like January 22nd, bullish divergence, MACD, RSI, nice move up. We right into the downtrend line. We pulled back and then broke out. Finally took out that downtrend line. That helps firm up the longer-term bullish case. Now, what's happened since? We came back in, pretty much rode back along, back testing that downtrend line, then moved back higher and hit this target. And this was, again, a level that I thought has, or still do think has a lot of significance. And we're right there right now, pretty much, just a hair below it. You can look at the volume at price histogram. You see all these large green and red bars, then the thin zone here. That helps show you that a lot of trading has gone down here, and this is really a basing range. And if and when we break above there, that will be bullish, and we'll probably fill that thin zone up here relatively quickly and move on up to this level here in PPLT at 108, call it 108.50. However, like gold, like silver, like a lot of other metals, like the miners right now, we have this divergence on the daily chart. You can see negative divergence on the RSI, potential divergence forming on the MACD. We do need to see the MACD turn down here, make a bearish crossover, and that will confirm that. So maybe platinum pushes up a little more, or maybe it just starts moving down towards the bottom of this wedge, confirming that divergence at that point, and then a breakdown, and that would take us a little bit lower. So again, like the rest, I do remain longer term bullish, just near term bearish on these. Not sure if my opinion, at least at this point, I can tell you, I'm not shorting right now. I'll watch the charts, and if I decide to put anything official or do anything unofficial, I'll post it in the trading room. All right, so that's platinum. And again, if and when we break out, that's the level. I'd be a little skeptical of breakout now. In fact, we had a little false punch through that level. I should actually have another line up there, because if you look back to the left, see these two reactions here? Yeah, I need to capture that. So there's really a zone, and to be safe, you want to wait to the top of that level goes about 130. And again, trade platinum while you're watching the charts of gold, while you're watching silver, while you're watching the dollar, because they all go together. Don't trade these in a vacuum, folks. That's where you get in trouble. In other words, if you take a breakout in platinum and gold and silver just fail to break out, and the dollar just broke out on a bullish chart pattern, more than likely platinum's going to fail. So let's move on. Silver, some recent bullish developments in silver. Let's just go to longer term charts. And this, I'll go all the way out to a weekly chart. This is SLV, the silver ETF. We're looking at a 10-year weekly chart. I've been pointing out for quite a while this primary downtrend line, the yellow downtrend line that really marks the bull market highs in silver. And silver has had one heck of a bear market, all the way down from the tops, about 70-something%. So longer term, even near term, this is a pretty darn bullish breakout. We finally took out that downtrend line. We took it out with conviction last week. Very strong divergences. So this is really a sub wedge or a sub downtrend line. You have this downtrend line here that was first taken out, and then we hit this the yellow downtrend line. There was some horizontal resistance there. That red line that was taken out. And, ultimately, I think we move on up to this level, almost 18. I have that line right now. It's at 1796. But again, if the GDX and gold and platinum all pull back, and it's not drawn out here, I'll do it for you. You look from this point to this point, you can see negative divergence on the RSI. We don't have divergence on the MACD. The MACD just eked out a slightly higher high, but we do have it on the RSI. And there is, if you look to the left, quite a bit of resistance. You look at the volume of price histogram. So, bottom line is gold and silver roughly move together, not in lockstep, but in overall. And if you take a longer term approach, within days or a couple weeks even, there can be some disconnects, but for the most part, they're going to move together. So that covers the precious metals. We'll just take a look real quick at some of the industrials. Here's copper, and again, silver is largely an industrial metal as well. So there's copper looks good from the breakout of this bullish falling wedge pattern. Had a nice move up. This was a resistance level I've had here. We've had 1, 2, now almost 3 tags at that level. And although this one came in just a hair lower, if we consider that 3 equal tags, and remember, this is the ETF. This isn't, I should put up the spot copper charts. I have it on another charting service, or copper futures. You might see 3 equal highs. The ETFs don't always do a perfect job of tracking. And if so, then what you have there is negative divergence, at least on the RSI, which is now turning down. The MACD, should it turn down, should copper roll over here, this MACD will certainly make a bearish crossover, and that will give you, again, from the point of those triple highs right there, those 3 consecutive highs, or failures, I should say, at resistance, then you have negative divergence as well on copper. So and that's, again, daily time frames. A daily time frame isn't something you're looking at trading for a day or two. You're usually talking a few weeks to a few months if these divergences play out. So let me see if there's anything else I want to cover here. I'll just wrap up with XLB because, as I mentioned, basic materials that sector will be impacted by the dollar. If indeed, again, if that dollar plays out with some dollar strength here. So I covered this in the most bearish sectors video the other day, and I know that analysis was contradictory. Somebody pointed out AA is a long-term trade, Alcoa, and it's in the basic material sector, and I didn't really notice a lot of these divergences and the fact that this breakout. I noticed the breakout, but upon further review of the charts, as I see things rolling over here, the MACD really lagging the RSI, and I see that this really could be a bearish rising wedge pattern, and this breakout may not hold. Now I've become a little more bearish on that, looking for a pullback. Still longer term bullish. I don't see any reason why this chart looks good from a longer term perspective. The basic materials, we're looking at a weekly chart, positive divergent low here on the weekly time frame. So, as I've stated, 2016, 2017, and maybe beyond, I think will be marked by commodities outperforming U.S. equities. But it's not always a straight shot. It never is in anything. So it's looking, again, near-term pullback, possibly for a few weeks, a few months, and then maybe we can add more exposure back to this sector. Okay, guys, I'll just wrap it up here with the dollar and the euro versus the dollar, the pair. As most of you probably know, the euro is the largest component in the U.S. dollar index. So if you want to know where the dollar's going, really, if you can tell where the euro and the yen are going, you can determine where the dollar's going because they make up the bulk of it, of the dollar index. And this again is a long-term chart, a weekly chart, which reaffirms my bearish stance on the dollar longer term, bullish short term. When you're looking at the euro US dollar pair, it's really in reverse. In other words, strength on this chart is weakness in the dollar against the euro. So what I'm looking at here, this is a very key resistance level. In fact, this is that same or very similar, if you will, to that trading range that I've talked about or highlighted in the dollar. And I expect an upside breakout ultimately of this range. You can see strong divergences here at the recent low, bullish divergences. So ultimately I expect a breakout. However, see this uptrend line here we had within the trading range and then an impulsive breakdown. Right now we're wedging up once again. There's an uptrend line. So to draw it out, this is what I expect may happen here. Dollar falls against the euro. Euro falls against the dollar. Gosh, sometimes you get it backwards and then backwards again. Euro falls against the dollar, meaning dollar up, which means commodities down. And then ultimately, we go on and break out above this thing where the dollar breaks down, which will benefit commodities longer term. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.